All right, well, let's kick off our property special with a look at commercial property, and I'm joined on the line now by John Ring, who is Director of Research at Savills. Morning, John.
Good morning, Gavin.
Give me your prediction first on the amount of money invested in commercial property this year and how it will compare to 2019, i.e. pre-COVID.
Yeah, so this year we're expecting €5 billion worth of investments to have transacted this year. That compares to about $3 billion last year, and pre-COVID it was about $7.5 billion, but that was due to a one-off sale of Green REIT. So a very strong year in the market, and we're seeing heightened demand across sectors, especially in the industrial and logistics market. That's really the investor pick of the year, I think, and we've seen yields contract there from 4.75 to 4% through the year.
Yeah, well, the reasons for the logistics sector doing well, I suppose, are obvious. And the other sector that's probably the standout is built-to-rent housing. But you identify affordability as a big problem in this area, I think rightly, John. I mean, some of these projects are pretty high-end, these apartment projects that these investors are doing, and one wonders, maybe they should be aiming a bit lower.
Sure. Look, investors actually try to deliver stock as best and at a more affordable level as they can, so that their product or their units then are available to the market as wide as possible, and that is really what they target. There's other factors behind the heightened cost of building, etc., cost inflation, etc., that could help in that regard. But we have seen very strong supply response in that sector. So there's about 5,000 units due in next year in 2022, and there's also about 5,000 units due to be delivered in 2023. So it's one part of the solution, which is addressing the lack of supply. It's not the only solution, but certainly part of the solution. And it's worth noting that the government themselves target approximately 6,000 homes per annum in this sector. So the supply has ramped up in the last while. So I think that will lead to real improving choice in the market next year.
How important are low interest rates in all of this?
Very much so. So low interest rates across Europe are the dominant theme at the moment. I think Ireland is actually less so than other countries in Europe because we've been the strongest performing economically. I mean, look, the domestic economy is due to expand by 7% next year. So we're a bit different to the rest of Europe in terms of having a really strong economic growth as well as the low bond yields. So that is certainly a facilitating investment. I wouldn't say it's the only factor.
But should we expect a pullback once we get monetary tightening, which there's more and more speculation about?
Yeah, so this is something that Savills quite a lot and we keep track of. Look, if you look at the long-term market expectations for inflation over 10 years, say, they're still well below 2%. So I think, it's interesting your comments there, hearing your comments whether they're transitory or not. What we do is we look at the market expectations, and they're still firmly anchored. Look, that might change, and you'll see pricing change along with that if things do move. But at the moment, the long-term inflation expectations and thus interest rates are still firmly anchored.
Yeah, so what you're saying there is maybe we might get a little bit of movement if there's a tweak in terms of what the ECB is doing, but over the long term, people still think these, investments, various types of commercial properties, they're a good bet to beat long-term inflation.
Absolutely, yeah. And if you look at Ireland as a spread over the rest of Europe, it's actually quite good value. So I think Ireland's well positioned at the moment, from that perspective.
How is the office faring as an investment?
Yeah, so when I was talking to you earlier in the year, the office market was really in a poor way. I mean, it was during a level 5 lockdown. Since then, we have seen the market really come strong in Q3. So we've seen about 400,000 square feet transact, and that was the fastest or highest amount of take-up transacting since the start of the pandemic started. In Q4, we're expecting about that double of that amount to transact again. So, for example, we've seen TikTok take 200,000 square feet at the sorting office in Dublin South Docklands. So overall, it's been positive. What's driving this is actually the remote working that has taken place through the pandemic, and that's allowed employment to be retained and grow. So we've seen employment rise in Ireland by 10% over the past year, but actually Dublin, normally office-based employment, has grown by 16%. And while much of that is being from home currently. That demand will be there then when things transition back to a more normal economy.
Yeah, we know a lot of sectors of the economy have held up pretty well despite everything that's been going on. Is it fair to say, though, John, that you're expecting sort of a divergence between what you might call ESG-friendly offices on one hand and the older, less energy-efficient stock on the other, a divergence in terms of values?
Absolutely. Look, this has been a trend for a while, but it's really accelerated over the past 12 months. In 2021, it's been a key investment theme. And, if you've two similar buildings, the one with the better ESG credentials will outperform one with that's less efficient or less efficient overall. So, absolutely, investors are probably ahead of the curve here, even in terms of public policy. Investors are really seeking assets to be energy efficient and low carbon footprint over the long term. And that's something that we're really seeing in the market as a dominant investment theme at the moment.
Yeah, probably a lot of the companies are looking to get their hands on that stuff in terms of being tenants. So it's going to be an interesting trend to watch. All right, we'll leave there, John. Thanks very much for that. That's John Ring, Director of Research at Savills. We'll be back right after this.